What is limitation on benefits, LOB, in a tax treaty? Imagine you are trying to get a special tax benefit from a treaty between two countries. But how do you know if you really qualify? That's where the limitation on benefits clause comes in. It is a rule in many international tax treaties designed to make sure only those with real ties to the treaty countries can claim benefits. This prevents people or companies from abusing the treaty just to lower their taxes. The main goal of the limitation on benefits clause is to stop what is called treaty shopping. This is when someone from a third country tries to use a treaty by routing income through a country with a good treaty, even if they have little or no real business there. For example, a company in a third country might set up a shell company in a treaty country just to get lower withholding taxes. The LOB clause helps prevent this kind of misuse. To do this, the clause sets specific tests or rules that an entity must meet to qualify for treaty benefits. These rules look at things like who owns the company, where the company is based, and what kind of business it does. For example, if a company is incorporated in a treaty country, it usually needs to show it has substantial business activities there. Or, it might need to prove that its owners are residents of that country. If these criteria are not met, the company cannot claim the treaty benefits. For Asian American taxpayers involved in cross-border work or investments between the United States and Asian countries, understanding LOB rules is very helpful. It can help you plan your business or investments so you meet the requirements and avoid surprises. If you structure your ownership and operations correctly, you can make sure you qualify for treaty benefits like lower withholding taxes or exemptions. To sum up, the limitation on benefits clause is there to keep international tax rules fair. It prevents third country residents from unfairly claiming treaty benefits. It requires entities to meet clear rules about ownership, residency, and business activities. It also helps protect countries from losing revenue due to fake or artificial arrangements. For Asian American taxpayers, especially those doing business or investing across borders, knowing how to meet the LOB requirements is key. It helps you use tax treaties properly and avoid problems with the IRS or foreign tax authorities. Being aware of these rules can save you money and keep your international transactions smooth.